Let's start with what is revenue based financing. Now, revenue based financing is a form of capital wherein you repay investors as a percentage of your monthly revenue instead of giving up equity or settling fixed loan payments. For example, you raise 100k in revenue based financing. You agree to pay back 130k total, that is a 30% premium, and you pay say 5 to 10% of your monthly revenue until the 130k is repaid. So the key traits out here is there is no dilution, there is a flexible repayment tied to performance, and there is no valuation negotiation. Now let's compare this to the equity funding, which is usually the way that it is done. Now equity is the traditional VC route. You give up ownership in exchange of capital, and the investor is betting on a big exit to make the return. The key traits for equity-based funding are dilution, valuation negotiation, long-term upside and control questions, and pressure for exponential growth. So out of these two, which one should you be considering and which one makes sense for you? Revenue-based financing is best when you have revenue, ideally more than 10k per month. You have high gross margins, you have predictable recurring cash flows, and you don't want to dilute your ownership. Whereas equity-based financing is better when you are pre-revenue or scaling fast. You need capital to burn upfront, you are aiming for a massive exit, and you want strategic investors involved. Let's also look at the real trade offs that are involved. Now, revenue based financing sounds founder friendly, and it is, but it does have its limits. For example, if you're giving up a share of your revenue, which affects your cash flow, it can be hard to quantify if you're too early or unpredictable. And it doesn't come with a network of strategic value that top VCs can provide. A pro tip out here is that you need to use revenue based financing as a bridge and not as a crutch. You need to combine it with equity after you know what the lifetime value of your customer is and what your customer acquisition cost is. So, in closing, we can say that equity is equal to big bets and big dilution. Revenue based financing is capital based on performance and there is no dilution.